Okay. Hey everybody, welcome to the video. I think you guys will really enjoy this video. Today I'm talking with Alan. He runs freecashflow.io. It's an agency helping online entrepreneurs basically do tax and accounting. Because this feels very niche, right? So if you're an online entrepreneur doing e-commerce, SaaS, you sell courses, content creator, whatever it is online, right? He helps these types of clients. So today I think this video will be very of much value to you guys. Purely he's gonna break down the top 10 tips, am I right, Alan, that e-commerce owners usually face with the tax and accounting, right? So he's gonna go through it, and I think especially applicable, especially because he's in the US, so US GAAP law applies and stuff. So yeah, okay. So I'll just let Alan take over from here. Yeah, Alan, go ahead.
Yeah. Hey guys, and hey Jonathan, thanks for having me on your channel. So my name is Alan Chen. I'm a CPA, which stands for Certified Public Accountant. And basically I run an agency that focuses mainly on online business owners, e-commerce, SaaS or, YouTube streamers, those kind of clients. And we're very focused on basically helping them maximize their tax deduction, helping them have their books being ordered and, provide all kind of consultation for them. So Jonathan invited me on his channel to basically provide you guys with some tips, and I thought it'd be a good idea to gather, the top 10 most frequently asked questions that e-commerce owners come and ask our agency. So yeah, just want to give you guys some value back just before our tax season started.
Yep. Okay, so Alan, I think I give you screen share so you can.
Okay,
go
sounds
ahead.
good. Let me share my screen with you guys. Cool. Can you guys see this?
Yep, I can see. Yep.
Okay, cool. So yeah, just again, our agency's name is Free Cash Flow. It's a little modest tax savings you can feel because we really want to emphasize on, maximizing your after-tax profit for all of you guys out there. So yeah, let me get started with you guys. Yep, so our topic today is going to be the top 10 most frequently asked e-commerce owners questions, and we're going to answer them all for you right here on this channel. So before we get really started on everything, we just want to give a little disclaimer here. Obviously, everyone's situation out there is different. This is just a a YouTube channel, video on the internet. So we don't want to guarantee that everything we say here is going to apply directly to your situation. But if you guys are interested or have a business that needs accounting or tax help, we would love to set up a consulting call with you so we can get really personalized and really get to understand your tax situation. But yeah, cool. Okay. And just a little bit about our mission. So our whole reason we started this business is to really help forward-thinking online business owners scale their business without ever worrying about accounting and tax issue ever again. This is a little known fact, but I actually was an e-com owner myself this past year. I really got to understand a lot of things about, how to run an online business, all about Facebook ads, how not to get banned on Facebook, Google, SEO, like designs, site page optimization. So I got to understand how much time each thing take and how you should be worried about scaling your business and not really worry about tax and accounting issues. So hopefully with someone like me, you don't have to go in and do something like that anymore. And then yeah. So I want to just go over a little bit about like what we see as a typical e-commerce income statement. So what you have is maybe like what you see as a top line revenue. So if a business Shopify or Amazon, you could be making 1.5 million or more a year. So that'd be your top line. Your COGS, what cost goods sold, is basically your inventory cost. So that's like, say it's 400,000. Operating expense is basically everything else. So that would be your merchant fees. That'll be the amount you pay your VAs. That'll be your tax preparation, shipping. Everything else goes in here and at the end of the day, your taxable income is around, we'll say $720,000, right? So that means if you look at the rate, that means you'll be taxed at the highest bracket if you're an individual filer, which means you're a single person, not married. So that would be amount to about $230,000 of your taxable liabilities for the year. So that's great and all. And that's, if you just hire a tax preparer, that's probably what they're going to say. Hey, dude, this is what you're going to be paying. But we want to kind of show you what will happen if you go and hire someone that really understands your business and really cares about, trying to find and maximize your tax deduction. So this is what we see when we take on a client, right? So not only do we just take the face value of what you give us as your financial statements and your revenue, we go and try to find, missed deductions, things that you may have missed because your accountant didn't ask you the right questions about things that you're doing this year. And then we also find ways to help you accelerate your expenses. So for this particular client, we saw that there was an opportunity for them to actually buy their inventory in advance, right? So instead of buying it, say in 2022, they decided, hey, I can actually take on that inventory now and take that tax saving now, and then I can have greater cash flow so I can reinvest in other parts of my business. So you can see the really big effect here because they do all this. They're only getting a tax to about $199,000, and we saw that there was a tax credit they can apply for, and tax credits are amazing. So tax credits, if you guys don't know, is a dollar for dollar return on your taxes, which means if you take a $10,000 tax credit, you get all $10,000 back as almost like a refund for you. So when they take the $10,000 tax credit, actual tax liability is only $189,000. So A and B, this is the same client. This is basically before they came to us and after they came to us, and you can see the effect here. So that's $40,000 in savings that they realize because they go and hire someone that really want them to succeed and do well, and not just file their taxes for them. Okay,
could I ask a question?
Yeah, of course.
So I mean, like, you go back one slide.
Yep.
You say at the 37% tax bracket, right? Like, I'm sure different states have different tax brackets, right? 37 is the highest.
Oh yeah. So this is federal tax, Jonathan. Okay. So so it applies to everyone in the United States.
Okay, understood.
Yep. Yeah, state tax is different. You're absolutely right.
Okay.
Yeah. So if we want to talk about that, there is definitely advantages of living in certain states, say like Texas, which doesn't have a state income tax. So if you can actually be flexible, so that's a great tip. If you can actually move your operations around and say move everything to Texas, only set up your nexus there. Hey, I'm in California and we have very high state income tax here. So if you can move out of state and just do it in a no income state tax, that's more power to you.
Okay.
Yep. Cool. Any other questions?
No.
Before we move on? Okay, cool. So we're gonna jump right in. So we're just gonna go do the top 10 most asked questions of our agency from our different clients that we have. So number one, of course, we always get is my ad spend tax deductible? So that can include, Facebook, Google, or Snapchat, really anywhere that you go and, you go do and pay ads, right? So just good news is, all advertising expense are deductible. So you don't have to worry about that. So one really important tip for you guys is, of course, always gather all your reports through the Facebook admin portal, do Google, to make sure you are maximizing it and you're not losing out any deductions. And it includes a lot of categories. So you're not just restricted to online advertising, right? You can do TV ads. I know performance TV is a big thing right now on streaming, magazines, even promotions on business cards, brochures, promotional stuff. Like if you guys are 8-9 figure guys and are promoting a sports team or anything, right? That's tax deductible. So don't worry about it if you want to go and sponsor the Golden State Warriors or something like that. And then another pro tip is, this is probably not something that's probably post-COVID, but say you're hosting a promotional event at a event show, right? And you want to offer them food. That's also deductible. So if you want to go offer some lobster bites to your customers, yeah, totally fine. Cool. So that's question number one. Do you have any questions, Jonathan, before I move on?
No, I think quite straightforward. Yeah.
Okay, awesome. So question number two is, how about my inventory? What if I am drop shipping, right? So that's something that we always get as the next most frequently asked question. So inventory is actually an interesting topic and a little bit complex. So inventory is actually one of the more complex topics in accounting because there's a lot of different ways of valuing it and a lot of different ways of looking at it. But we try to keep it as simplified as possible, right? So before we answer that, we want to make the custom kind of client aware that there's a difference between inventory you purchase versus inventory you consume or sold, right? So inventory that you sold, this is of course for those established ecom owners out there that holds inventory in like warehouse or fulfillment centers. That's called cost of goods sold, and it's considered direct cost, and it's subtracted from sales to get your gross profit. And you're actually allowed to take any and all cost of goods sold during the year. So anytime you sell inventory, that's a deduction to your taxable income. One thing to consider is, of course, there are different methods to value inventory. So there's cost, there's lower of cost of market, and there's retail. So without going too deep into it to bore you guys, this will actually control the amount of cost of goods sold you guys can take, because the different ways you value that inventory means the different amount of the actual amount of cost that you can deduct that year. So for example, if your inventory all value very high, right, at the beginning, then you can take more at the beginning. But then that means later years you might only be able to take less. So there's a lot of planning involved there. And then for those of you drop shipping out there, you don't have to worry as much. Obviously, when you're drop shipping, your cost of goods sold is what you pay for to your supplier, right? So you're overseas, say your China supplier, that's kind of like your middleman. So it still makes it very important to keep good records, right? Because I know from my experience, working with someone from China or overseas, they don't really supply you with much records. So if you're someone who has made it to 6-7 figures or beyond, this is utmost important to request some kind of purchase order or some kind of proof, because a lot of people, payment providers and especially the IRS, going to want to see that you actually have a way of verifying and validating that this is the cost of the inventory that you purchased. So that's something to really keep in mind. Also, another value add is don't be afraid of having like obsolete inventory. Obsolete inventory is basically inventory that's dead, right? That you don't feel like has any value anymore to you. Obviously, you don't want that, but that is actually something that's also deductible on your taxes. If you get to a point where you can make a 100% determination that inventory is no longer worth any value. Okay, so that's inventory.
I'm guessing
yep.
this. So just to interrupt.
Yeah, of course.
This inventory stuff, is this related to the accelerated deduction in the past slide?
Yeah, really good question, Jonathan. This is so for someone that is looking to try to get back a little bit more after tax money this year.
Yeah.
Buying inventory in advance is a amazing way of doing that, especially if you're a cash basis taxpayer, which I'm guessing most of your ecom owners out there. I would say the only case there would not be you is if you're over 25 million in revenue this year. Then you're forced to be in a accrue method. So there'll be a whole different case in that realm. But if you're a cash basis, there's a lot of ways where you can move things around, especially at year end, where it's all about cash, right? Cash goes out, it's an expense. Cash comes in, into revenue. So as long as your cash goes out in the right tax year, you can accelerate that expense and get more back possibly on your tax this year.
Okay. So, I mean, why would people not use accelerated? Like, won't they always use it since it's more advantageous to them tax-wise?
Yeah. So that's a really good question too, Jonathan. So there's two reasons, right? When you accelerate your expenses, it's basically a planning move. So you're planning to gain that benefit now, but think about it. Next year during your taxes, you may not be able to make the same move if you don't have a similar inventory value, right? Because you already did that in the year prior.
Yeah.
So it's really about how you want your cash flow to go. If you need that cash flow now, first you need it for next year, right? So if you're planning a big move right now where you need another $40,000 in cash to do other things, right? So you really want that tax refund to come back to you, then that's something that you can talk to your accountant to do for now, for the current year.
Okay.
And then the second reason is, of course, just a matter of cash flow, right? Do you have $40,000 in your bank account to afford that inventory? If you do, then you're in a really good situation, and that's something we want to plan for you, right? If we see that you have that excess cash and just sitting there, you're not putting it into other investments, for example, then you're like, okay, let's do this. Let's see how much tax saving this versus hey, say you invest that money.
Okay, understood. Yep.
Yeah, cool. Yeah, no problem. Yeah, feel free to interrupt me anytime if you have more questions. So we'll keep going for now.
Yep.
Question number 3. So this is I get a lot. I get texts about this. I heard about a business owner gets to travel for free, but how? I'm sure Jonathan would be interested in this
Chase
too,
Sapphire
right?
card,
Yeah. So yeah, there's of course business credit card hacks that you can take, but there's actually also very legit ways of doing it as a business travel. So first of all, we want to establish that everything we do at FCF agency, we try to stay very I would say green, right? We try to stay away from anything that will get you in trouble. So we want to emphasize that for first of all. So first of all, business owners, you do get to travel for free, but not exactly how you think about it. Okay, so let me explain. So there are no free lunch in the world, first of all, right? So the way that you can travel free is this. First of all, you have to establish the first requirement, which is having a business purpose, right? So you go and say you want to travel to a country or to a state. You first have to need a business purpose. You need to have it needs to be a client meeting. It needs to be a conference. It needs to be R&D for the business. Say you're traveling to China to talk to suppliers. It needs to be to be a potential to generate revenue, some kind of potential to generate revenue. The second requirement is that it's ordinary and necessary, which means as part of your industry, right? Ecom, that people do this kind of traveling. It's not out of the ordinary, right? That you guys go to this country. Like if you right now go travel to Antarctica, people are like, what's in Antarctica for you, for your business,
Yeah.
Yeah, so you gotta be ordinary. And another pro tip to mention, I don't think this is something that a lot of people know about, is domestic international travel is different. So domestic is kind of a all or nothing rule. So domestic, if you go and travel less than 50%, you don't. Sorry, if your travel is less than 50% business related, none of it is deductible.
Okay.
But if your travel is 50% or more, then you can deduct all of it. Well, international, it doesn't work that way. International is proportionate. So if you're 60% of your travel is business related, then you get 60%. 20% of it's business related, you get 20%. So you really got to make that differentiation if we're traveling like domestically in the United States versus internationally. So a lot of planning involved there. And the third thing is, of course, detailed record keeping. You don't want to get in trouble where, you're doing all this business traveling, but, of course, sneaking in some fun. But then IRS like, hey, I don't actually think this is a real business trip. I think you're just going to Cabo or Miami for fun. You don't ever want to get to that point and you can't prove it. So you want to gather all that vendor and client data, right? You're like, hey, I actually talked to this person. He's a representative that works for this company, and this is the time we met. This is the location. Here's my receipt. You want to have that kind of backup to make it so that you can sleep better at night, I would say.
Yeah.
Just
to justify that, hey, I was at this business meeting. You just gotta keep records and a timeline, and then put it in a file somewhere. Okay.
It's exactly right, Jonathan. You want to make sure that you kind of jog that you actually did meet with that person, right? Whoever client it was. If you went to an event show, right? You have a brochure that says, hey, I've been to this meeting. This is the speaker that I was listening to, at this meeting. Yeah. What you do maybe after the speaker, maybe you go to K barbecue. That's on your time, right? But hey, you got that free travel out of it because that's part of business travel. But I'm gonna throw up an example actually next of how you can really plan for this. Okay. So Adam, a client, is a 7-figure nutritional brand owner, right? So he comes to us and say, hey man, I got this big trip that I always plan every year. He goes to us basically a nutritional brand trade show. And he always goes to Miami every year, but he says, oh damn, I'm so busy. I never have time for vacation. And I was like, hey, you can probably work that through the business trip that you're taking. That's what we told him, right? So we're like, hey, maybe you can spend the beginning and end of the days doing what you need for the trade show. But in the middle, you can kind of actually choose what you want to do. So, but basically, because he does that kind of planning where the beginning and the end of his trip is business related, the flight is covered. Because that's all IRS gonna see. Did you intend to go to that place for business reason? Yes. Did you, at the end of the day, did you finish your business and go back home because the business reason ended? Yes. Now, what you fit in between day 3 and 5, that's up to you, So as long as like we talk about, you keep all email confirmation, trade show schedule, name the speaker who you talk to, then you're gonna be pretty covered. You can be sitting on this little infinity pool on the right. And then really enjoying your time day 3 and 5, and there you go. That's the free traveling. And a little bit more tip here. When you do business traveling, there's a lot more than just travel and meals that's covered. I think that's what most people know about. You can actually, if you pay any gratuity like tips to people, your laundry, baggage fees, rental car, dry cleaning, those are all deductible as long as you do them during the business part of your trip. So get them done day 1 and day 2 and day 6 and day 7, basically in this example. So yeah, Jonathan, if you're planning a long trip, like to some country, like the Thailand or something, 10-day trip, right? As long as you're day 1, day 10, you're out there, teaching people how to do Facebook ads. Hey, day 2 and day 9 is up to you, bro.
Okay.
Do whatever you like.
Okay.
Yeah. So you should plan your seminar around that,
Okay.
Cool. So we'll move on from here. So we're gonna go to question number 4. So next question we always get is, how about driving, right? Mileage for business purpose. So say they go and drive for the purpose of going to post office or a workplace, warehouse, a business meeting. And yeah, that's totally deductible. So there's actually 2 ways of figuring this out. There's what they call the standard method and the actual method. So standard method is very simple, and I actually recommend that for all of you guys starting out there to do your taxes, to follow the standard method. And standard method is basically a rate IRS gives you. It changes every year. For 2021, I just looked this up. It's 56 cents a mile. It actually went down 1.5 cents from 2020. And basically, all you do is you take the miles that you travel to and from the place of business, right? Record it and multiply it by that rate, and that's the amount of tax deduction you can take. So that's great, but then there's actually the more complex way, which is called the actual method. So the actual method is a little bit more complicated, but it actually could give you back more savings possibly at the end of the day, because the actual method basically lets you deduct a lot more. So I'll show you the next slide. So the actual method lets you take all these things, right? So you can take gas, oil, maintenance, repair, registration fees and taxes, license, insurance, vehicle loan interest, rental or lease payment, depreciation, garage rent, tolls, and parking fees. So obviously, when you're doing all this, it's a lot more involved, but it's a great amount of categories you can take. But don't think that this is always going to be the better method. So I'm going to show you 2 examples of why we say this. Okay. So first example is so you have a vehicle that you're using about 18,000 miles a year, right? A business vehicle, and you use it for 90% of the time for your business. Okay. So which means about 16,200 miles each year. So if you use the actual expense method, you basically go and log, how much gas and oil you take, registration fee, insurance, loan insurance, interest, lease payment, and total expense. So with that said, your total deduction is about 8,640, right? But then the standard mile method, which is a lot simpler, you're literally just taking the actual business mile you have, which is 16,200. You're timing by the mileage rate. Oh, this is my apologies. I should update with 2021, but for 2020 is 57.5, so a little bit higher. So then your total deduction is you get to take is 9,315. So you can see actually you're doing all this work, but actually the standard mile wins in this case, right? But let's switch it up. Let's say you are a person who are actually driving a more of a luxury vehicle, right? Or just a bigger van or something that you need to store all your inventory for stuff, for example, right? So in the luxury vehicle example, all your things are more expensive. Your gas more expensive, your registration fees more expensive, insurance, your lease payment is $1,200 a month because say you're a big baller and you have a Mercedes Benz, right? So your lease payment is a lot higher. Well, look at that. Your total expense is just 24,000. So if you take that expense and multiply by business use, which is 90%, you get 22,000 of possible expensive here. But then if you only did the actual business miles method, that's only gets you about 9,315. So you can see there's a big difference here by not checking if the actual expense method is the right one for you. And I feel like a lot of times when you go to an accountant that doesn't really, how busy, who doesn't really like look out for your business, they'll just do the standard miles method no matter what, right? Because it's easy. You don't even need to pay someone to do this, honestly. Like you can calculate this yourself, right? You just have to keep good mileage records and multiply it by rate, and there you go, right? And that's sometimes okay, but sometimes you can be missing out almost $10,000 in tax deductions. So you can see a big difference there, right, Jonathan?
Yeah.
Yeah. So, okay. You have any questions there, Jonathan?
Nope.
Move on. Okay. So next we have, my business is growing. Question number 5. Can I hire family members to help? So we get this question a lot about, I want to hire my nephew, son, or, third cousin tries to move. Is that okay for my business? And that's actually a legitimate legal tax deduction you guys can look into, especially if you're running a family business. So it's a concept called family income splitting, right? And basically allows you to split your income so it doesn't all get taxed at the higher bracket. So it actually allows you to basically keep more of your after-tax profit. But it's one thing you got to watch out for was what they call the kiddie tax. So kiddie tax is basically in the 1980s, people started abusing this. They started saying, hey, I have a kid who's like 5-year-old. Let me make him an employee of my company and pay him $100,000 for, opening mail or some dumb things like that, right? Yeah. And IRS and Congress basically caught on and say, hey, you can't do that. That 5-year-old should not be first child labor law, should not be working for your company 80 hours a week. So you cannot pay $100,000 due to simple things, right? Yeah. So the kiddie tax basically saying that whoever's working for your company, they need to be legitimately doing something for your business, right? They need to be running logistics, running marketing, and they need to pay a market rate for it. So basically, they're saying no one's going to pay a 5-year-old $100,000. What they're saying. Therefore, if you try to get around this and pay a 5-year-old that, they're going to catch you and call it a kiddie tax, and you get taxed at your rate anyway. So it's not worth it doing it that way. So if you're going to hire someone, basically you need to hire someone that is actually doing work for your business. Okay. So just want to give you an example. So we have Steve, who is an e-commerce owner, making $300K a year. And this is a tax bracket that we have here. And basically he decided that, hey, I'm going to be hiring my daughter and then my nephew, Greg, to do 2 legitimate things for my business, right? So my Sarah's going to run social media for me, and Greg's going to do fulfillment. And I'm going to pay them $50,000 each. But you can see by doing this, the 100K now is allocated to the 22 percentile and not to the 35%, which is what he would have got taxes for all $300,000 of his net profit. But by splitting it, some of it's only going to be taxed at 22%. So he realized the 13% difference in between those two brackets, which is awesome. And just something that you can definitely do if you have a lot of people working in your company. So don't be afraid to hire your family members to get them to help out. Okay. The next question we have, this one's really popular now that we're in the COVID environment is, I'm working from home. Well, what kind of deductions can I take? And this has been a very in-demand question in our agency lately. And we've done a lot of research on this actually. And the good news we want to tell you is there is a home office deduction that you can definitely take if you're an online business owner. And to qualify this, basically, you just got to meet two conditions. One is you need to have regular and executive use for your business, which means that the space has to be for business use only. So basically, it has to be an office space dedicated to your business. It can't be a nursery, it can't be anything else, right? It can't be your dining room also. It has to be a space that's just for that. And the second requirement is it has become now your principal place of business. So basically, you can't have a home office and also have an office outside of this office also. So that's something you just got to keep in mind when you're running when you want to take this deduction. And just like with mileage, there's actually two ways of taking this. There's the easy way of doing it, which is just taking. Actually, you get $5 per square footage, and then you get up to 300 square foot of your house, right? So just 5 times 300. That's the maximum deduction you take. But then there's also the more complicated method, which is also called the actual expense deduction, which you can deduct the actual percentage of business use that your business take up in your home. So you can take up however much your business take up in your home. You can take a portion of your mortgage interest, any kind of taxes like property tax that you paid, maintenance and repair that you guys do, insurance, utilities that you do. So that's actually could add up to a lot of deduction that you can possibly take. So that's something that you want to really watch out for, especially if you are using more than 300 square foot of your home for your business.
Yep.
You want to see if you can talk to an accountant that can help you take some of these other things for your business, and that can add up to a lot more than the just the simple method of taking this deduction.
Okay.
Next, we have question number 7. Why set up an LLC? What are the benefits? So, without going too much into it, some of the benefits that you guys might know about is, of course, the limited personal liability that you get. So, basically, I see a lot of people that starts out as entrepreneurs, right? That keeps everything in their personal account, and that's very dangerous, actually. Basically, if they say you run a toy company, right, and you get sued, right, because one of your toys is toxic, it's from China, and a kid gets sick because of it. What the parents can do is basically sue you and sue your entire person, which means, if they win the lawsuit, they can go after your house, your mortgage, your car, your boat, everything that you own, basically. And you don't want that. That's why people set up LLCs. LLC basically provides that shield against that kind of thing. When you have an LLC, the parent or whoever it is, it's an example, can only sue your LLC, which means that they can only take up as much as business asset that's in your business, and they can never touch your personal stuff. So you want to make sure that there's that really good distinction between business and personal, because if the court finds that you guys are mixing the two, that's really bad. Then it's a concept called piercing the corporate veil, and they can come after you too. So just a pro tip that we always recommend clients is, please, for the love of God, separate your expenses out. Make sure you have a business account and a personal account. Don't mix the both. Don't commingle. Don't, hey, I want some points. Let me put in my business account. Don't do that, because they'll just get you in trouble. Okay. And the other things, of course, no double taxation. LLC is a lot easier as far as paperwork. If you go and set up and if you really incorporate, become a C corp, right, a corporation, you get taxed 2 levels, at the shareholder level and also at the personal level. But LLC does not that. There's no, and the third thing is there's no restriction on the number of type of owners. So you can actually take in owners that are entities. You can take in international owners too. It's just you have to do a little bit more paperwork and distribution types in doing that, but you can. And of course, flexible profit distribution is the last benefit of LLC. So what that means is, say you and your partner both go into business, but that guy only has enough to put in $2,000, right? And you can put in $10,000. Well, that still means that you guys can do a 50-50 split of the business. And that doesn't mean that how much you put in is how much you need to split a profit. It's totally up to you how you want to distribute that. So a lot of flexibility there, and it doesn't have to be a proportional amount of contribution. Cool. And then, we're gonna go to question number 8. Oh man, question number 8 is one of my favorite questions. So I'm making money now, man. I'm rolling in this dough. Like, how do I stretch this dollar to make it last longer? So that's one of my favorite topics, actually. of helping clients realize that, they're doing great in their business and that's awesome. But I'm sure a lot of them are hoping for the day where they can just sit back and really enjoy the fruit of their labor, really get to enjoy themselves. So something that we always get on a call with them is talk about like a retirement options they have. And there's a lot that they can do, a lot of different plans that they can do, even as a small business, that they can look into, like 401k, SEP IRA, Roth IRA, that they can really set up for themselves to not only possibly reduce their tax situation now, but they can also invest that money, let it grow tax-free, and really set themselves out when they want to retire one day. And another thing that hopefully someone talks to you guys about, it's just what we call HSA. It's a health savings account. It's basically another investment vehicle that the government allows you to do that lets you not only put in your money tax-free, let it grow tax-free, and at the end of the day, you can take it out tax-free for any kind of medical health related reasons. So that's powerful. You guys, if you're in the United States, you know how not that great the medical system is in the US, right? In some other countries, you get free medical care and that, but in the US, you really got to prep for that. So health saving account lets you basically not have to worry about that piece. Like when you get older and you actually need the medical expenses, you can draw from this account at that point. And hopefully at that point, your account has grown to a good amount where you can afford all that without any problem. Another thing we always talk to our client about is asset diversification, right? So don't just focus on one stream of income. Yeah, we know your brand is doing great, but now that you have this extra cash flow, you should think about putting it in real estate. You should think about putting it in stocks, bonds, ETFs. Make sure that you have a diversified stream so then you're well taken care of no matter what happens to your business. Most of those streams of income, we always try to explore different ways that they can look at into affiliate marketing, merch, anything that's not their primary business. Maybe they can go do as an event speaker. I know that's a very popular role right now. And then at the end of the day, we just want to help you find passive income, right? Things you can do on your boat on a beach somewhere and just earning money for you while you do anything, and that's what we want to do. And the last thing is, if you still think your business is very viable, you want to just hire an amazingly talented team to take over for you, So at the end of the day, you just have to look at your financial report, that your accountant gives you and say, hey, this is how much your business is making a day. Your tax situation is taken care of. You're good to go. You can keep going on your vacation because you have a great team that you're taking care of all that for you. And that's very comforting as a business owner who has done this for a while.
And can I ask, right?
Yeah, of course.
Your HSA. So in Singapore, I think it's called CPF. I think it's the same thing. But basically, you put in money and then you invest it tax-free, right? So like, is there a cap to how much you actually can contribute to this account?
Yeah, there is actually. So there's an individual cap that it's about 7,100. And then if you're married, it doubles that to about 14,200. Something around there. It changes. Yes, per year.
Okay.
So it changes. There's a little bit of inflation that Congress changed that every year. But basically, you can if you especially have the cash flow to cap out on it, because it basically helps you lower your taxable income that you have this year by that amount, right? So say 7,100, and then not only that is you can put that money in, it'll grow tax free, and at the end of the day, you can take it out, all of it tax free for any kind of medical issues you have. So it's really amazing, and it's
also
something
only
that
for medical, only for hospital stuff, bills.
Yes, only for any kind of medical things is tax free. But if you don't, I think it's like a 10% penalty, which is not as big a deal as you think once you let it grow for 10, 20 years.
Okay. So, just last question, sorry. The asset diversification, right? Would you recommend buying like bond stocks within your company, or do you take it out after tax profit, then you go and invest? Like, can you actually invest company money and then let it sit within the LLC?
So you can invest on behalf of your LLC. It just depends on how you set up your LLC, right? Because you gotta think of LLC as not just your own, especially if you're not a single member LLC. If you have multiple members in your LLC, you have a lot of partners. All those decisions you can make as long as you can make as a group, right? So what I'm saying is you can do that. It just, as long as you get along really well with your partners and your members, and you guys can always come to the kind of investment decision you want to make together, I would recommend this path. But I hardly see businesses in that setting, right? Where everything's just harmonious, where everyone just want to invest in the same thing, right? So say I want to invest in Tesla, but you want to invest in some other company, right? We might disagree, and because using company money might actually create more I would say controversy and argument, but you can. It's totally fine. But I actually would recommend that you take the after tax profit of your own and invest it because you have more control over it. You can do more what you want with the money. That's my recommendation.
Even if for example, like you are like sole entrepreneur, right? Is doing LLC, you're making like $4 million on Shopify per year. Does that still make sense, or you still should probably take it after tax profit and invest that?
Yeah, so that's a concept that a lot of people don't know about. Is if you're a sole proprietorship, even if you have an LLC,
not so but
sorry.
more like your one-man LLC, like you're the sole owner.
Exactly. Yes. Yeah. Sorry, I misspoke. If you're a one-man LLC, they basically, what they call it is a disregarded entity. They're basically saying because you're only one person, the LLC really doesn't take as much effect, if that makes sense. It's like they see you as just an individual person, basically disguising as an LLC.
Okay.
If that makes sense. Yeah. You actually most of the time don't want to form just single member LLCs. You want to form a partnership. You want to form multiple member LLCs. So they, as in a court of law, they see you more as a legitimate business rather than someone who's just looking for, personal liability protection and forming an LLC. So what I'm saying is, if you're just a single member LLC, they will treat it the same way.
Okay.
Whether
so
you invest as part of the company or yourself.
Yeah.
Yeah. You should just take it out because they're gonna make you take it out. Yes.
Okay.
Yeah. Yeah. So you can't hide that way, unfortunately. Any other questions, Jonathan?
Nope. I'm okay.
Okay. Cool. I'll move on to the last two questions we have now. Number 9. Something that a lot of people don't worry about is, of course, about sales tax, right? It says, should I be worried? And when should you be worried about sales tax, right? So one thing is we want to make sure that ecom owners are always scaled to a certain point. They start thinking about this. And it looks really troublesome at the beginning, right? So, and it creates a lot of compliance issues for companies that don't get a jump start on it. But there's good news. Most states have certain sales thresholds you need to meet before they will even go after you. So I would say that unless you're at, I would say like 3 to 500K mark, you really don't have to think about this. Really, like the only state that you kind of have to think about is just your own state that you have this kind of issue with. So say I'm in California, right? I would just need to make sure I collect sales tax for California customers. And then I need to file sales tax for California. But for any other state, I don't think you need to worry about much until you get to a really high revenue point. And then, then you probably need to look into it. But just don't worry about it. Like one of the things that I want to mention is our agency, we provide an annual state-by-state sales tax impact report for you guys. So what we do is we basically analyze your entire customer list, break it down into states and how much impact you have per that state, and when you actually need to be alerted to file for that state. So with that, you kind of know at one point you need to worry about it. And then if you don't actually meet that certain sales volume per state, you can just kind of forget about it. So yeah, not too much to worry about anyone that's making, I would say, less than 3 to 500K.
This per year, right? 500K per year?
Per year. Yep.
Okay.
Mm-hmm. Yeah. If you're making 3 to 500K per month, you really need to start worrying about this now. Yeah.
Okay.
Give account a call like today. You don't want to hesitate if you're making that much.
Yeah.
Because that's over 6 million a year, Yeah. Okay, great. Now, last but not least, this is just a little plug that we have for ourselves. Why should I hire you, right? Why shouldn't I go and just hire someone that just a family friend or someone that's recommended to me or someone I Google? I hope from all these questions that you've seen before that you kind of get an understanding that it's not so simple to just hire someone who's just a tax preparer, right? Someone who's just a tax preparer most of the time is just going to take the number you give them, put it on some sheet and say, bam, this is how much you got to pay. Like, there it is. Pay that amount, and that's fine. But you can see that you're actually missing out on a lot of possible deductions this way. Just with that income statement example at the beginning, just with the actual the mileage you saw, just with the home deduction, there's always different methods of calculating those things. So if you don't do things like proactive tax planning, you're very likely to miss out on those things. And you also want someone that's really laser focused on your niche, right? So a lot of accountants I see are generalists. They'll take on any kind of client, right? Retail, brick and mortar, real estate, just some fruit stand in the streets. You don't want that because they're just going to apply really general tax knowledge to your business. You want someone that's laser focused on online business. Why? Because the IRS tax code is it's not that complicated. It's just thousands of pages. That's all. You want someone that's like only reading the part that's related to you. You know, if they're over there like talking about mumbling about things that's not related to your niche or your brand, that doesn't help you. You know, so you really want someone that's really like here to maximize your tax deduction. Like when our company setup, tax preparation is actually the last step. Like what we do before that is, you know, we prepare all your bookkeeping, we make it clean, we go into tax planning, then we talk to you about what your goals are for the future, you know, what you want to do, and we really plan that out for 3 to 5 to 10 years, and really see, hey, does that make sense in a legacy setting, right? And then does it make sense of how you want to retire and how you want to leave behind money for your dependents and your beneficiaries. So we really want to focus on that. So with that said, this is kind of like all the things that we prepared. We also want you guys to know that you kind of want someone that has that synergy, right? That does your bookkeeping, your tax planning, your financial reporting, and don't need to go to different sources for different things. You want someone that can do it all and can just become a one-stop shop. So you don't have to talk to, no one wants to talk to 3 to 5 accountants, right, Jonathan? You probably only want to talk to one accountant that's just like, hey, let me just do one call and I get this taken care of and I could go on and do my business and go back on my boat, you know? So you don't want to go and have like 3 to 5 conference calls a month. It's like, hey, I need to talk to my bookkeeper here. I need to talk to this guy doing my sales tax. I need to go talk to this guy doing my tax preparation. Nah, that's a lot of headache, and you're trying to get rid of headaches, you know. So that's kind of why a little plug here. Just want to mention that, you know, we're not really just here to do your taxes. That's like the last thing we think about. We feel like if we had done everything else that we're supposed to have a deep understanding of your business, this would take care of itself as far as filing your taxes for you. We're really pretty much done. We actually have a lot of other questions that got submitted.
Yeah, we have questions on the chat, Alan.
That we just want to mention things that our agency has seen. But you know, if there's interest, we can of course answer some of these other questions and maybe in another interview some other time. But yeah, just want to let you know some of the other questions that we may have gotten out from. I think Jonathan, your audience may have some questions too, right?
Yeah, let me open up the chat. Wait. Okay, so first question comes from Aaron. Okay, I won't say the name. For
Aaron?
an average
Aaron.
ecom, from an average ecom owner, what are the easiest low-hanging fruit adjustments that you can do to save taxes, and how much can you expect to save? Yep.
Yeah, that's a great question. So like 2 of the things that we always mention, if you just want kind of like low-hanging fruits, is your merchant processing fee. So a lot of people don't consider this when they're filing their taxes, right? So this is like basically the fee that Shopify charges you, or Stripe, or like a PayPal, and you can actually deduct all that fee they charge you. So if you think about it, you run like $1 million or $2 million business, right? And they charge you 3 to 4% of that. That's $30,000 to $40,000 of extra tax deduction that you should be taking for your business. So don't forget about that. Make sure you keep all that reporting organized. If you don't know how, you feel free to DM us. We'll show you how to, find those reports. But make sure you gather all that up and then really, go take that tax deduction. It's all tax deductible as online business. Another thing is something we mentioned on one other slide is mileage, right? So if you don't have time to, if you don't having a chance to hire someone an accountant, you can just do the simple method, right? Which is taking 56 cents per mile and just multiplying by the number of miles that you're traveling. Bam. And that's another great, easy tax deduction right there.
Okay. Next question. Is there any way to invest the cash back into investments, example stocks? Yeah. So I mean, you think you mentioned it, but I guess this guy wants.
Yeah, for sure. Yeah. I mean, it's actually really highly recommended to diversify your cash flow, right? So currently in the United States, the capital gain rate is a lot lower than your ordinary income, right? Ordinary income is basically your business income. But capital gain rate is basically the amount you realize from investing in like stocks, bonds, ETFs, mutual funds. So you actually really want to take advantage of that by putting money into those kind of investment vehicles. So then later on, when you take it out, you actually get to tax at a lower rate at the end of the day, right? So I think right now, if you have you're taking out 80,000 or less in your investment gains, it actually only gets taxed at if you're married filing joint, it's 0%. So it's 40,000 for single, 80,000 for a married filing jointly. But then between 80,000 to $215,000 around there. Don't quote me on that. It's around just 15%. That's the tax rate. So you saw the tax bracket we put up. It can go up as much as 37%, right, on ordinary business income. So that's a huge difference right there.
Okay. Next question. could you explain more about the 401k in the previous slide?
Oh, 401k. Yeah. So 401k and, SEP IRA, simple IRA. There's a lot of different ones that depends on your business could work the best for you and your employee. Actually, you can set up a plan for your employee. And basically, depending on what plan you choose, you need to put in pre-tax or post-tax dollars into these investment vehicles. So, for example, if you're just doing a 401k, you can take your pre-tax money. So, for example, if your business is making a top line $1 million, right, and you can put in, I would say like 18 to 20,000 into a 401k. That means that $20,000 is not getting taxed for this year. Instead, you put into this 401k plan, and it basically gets to grow tax free. But then over 20, 30 years, you'll grow to a certain amount because the stock market usually return about 7 to 8% over life over 20, 30 years. And then at the end there, you have a pretty nice retirement fund there that you can take out and use. I think there are ways to take it out early, but the normal retirement age that you can take it out is 65. But there are other, I would say, retirement strategies can allegedly take that out a little bit earlier than that.
Okay. Patrick asks, when do you recommend getting an accountant? Is there a specific dollar amount you should then look to get to hire one? How should I go about looking for one?
Yeah, that's a great question, Patrick. So it's actually recommended, and I kind of mentioned that a little bit already. Once you get past, I would say the 300 to 500K mark in annual revenue, you probably want to look for an accountant at that point. And maybe you don't need someone that does your taxes exactly. Maybe you just need someone that does your bookkeeping, because at that point, you probably have a pretty high volume of transactions in your business. So you want to have someone that can really, make sure your books are organized, right? Because one of the things we always see from client is, why do I not get all my deductions? Well, it's one reason is probably because you have very messy bookkeeping. And what messy bookkeeping does is you don't know like a certain transaction, if it's tax deductible or if it's only 50% or if it's 0%, you have no idea. So you just go and you put it down in a bucket, and that's not the greatest plan, I would say, once you start making real money, because you really got to think about your tax planning as just another stream of revenue for you. You saw in our previous example, right, Jonathan, and on income statement slide,
yep.
Like by doing great and advanced tax planning, that's 40K. I mean, you would love to have 30, 40K back in your pocket, right? But not doing much work. And that's basically what happens. If you hire someone that really understands your business, you can just get that back, and you're not doing that much more. Yeah. You just hire the right person that really understands your business. So I would say, if you're around 300, 500K mark, definitely start looking into an accountant. But obviously, if you're in the high 6-figure, 7-figure, you really should look for someone that seriously understands your business, really want to help you with tax saving, really want to help you with what you want to do in the future as far as your financial plan, and they help you scale, really.
Yep. Okay. Lucy asks, even I have this question. What software systems do you recommend personally? What type of source documents do you need to keep up with, and how should I go about setting this up? Yeah.
Okay. Software meaning like accounting system, right?
Yes. I think so. Yeah.
Okay. Yeah. So I think for most of you guys out there, and even our agency uses too, is QuickBook Online is really good. It's one of industry standards as far as accounting software out there. There are, of course, more sophisticated software out there once your company grows to a certain amount, a certain size, especially if you start dealing more like payroll and more complicated issues like issuing debt, stock options, employee benefit plans. But I'm thinking for most of your e-com owners out there, you guys probably not to that stage yet. But if you are, talk to us. We'll set you with a better accounting software. But for most of you out there, I think QuickBook Online is a great thing to get started, and I would highly recommend that over just keeping that in Excel, right, manually, because you guys gonna really start tripping up, and it's gonna be really hard to pass that on to accountant if you only keep your records in Excel. So as far as payment processes go, you basically just want to go and download all the monthly statements that's generated from their websites, and just keep your records, keep it in some kind of secure data hub, right? So at our agency, we take we take the client's data, and we really keep it secure, and we really keep it ready, so that if anything happens, if IRS come back to us, we're always audit ready, right? So if you ever get flagged, and you might, if you start making 7 figures, don't worry about it, right? If you hire the right person to watch out for your finances, all your documents, all your backups is ready to go. So you don't have to worry about it. So you have a panic when something like that happens, and you're gonna pass with flying colors.
Okay. Does QuickBooks have payroll at this point?
Yeah, no? It does.
Oh, it does? Okay.
It's an add-on. it's an add-on. It's probably not the best solution, but I think if you're only hiring around 1 to 10 employees, works perfectly fine.
Okay, understood. Okay, Daniel asks, if we are hiring VAs and such, how do we expense this? How do you go about structuring deductions for hiring VAs, and any special scenarios?
Yeah, that's a great question, Daniel. So hiring VAs is interesting in the world of online e-commerce, right? Because as Jonathan probably knows, a lot of people just hires a lot of people from overseas, right? International VAs from different countries, and honestly, there's not a lot of guidance around this. The reason is, okay, when you hire a VA, they're in the US, they're what they call independent contractor. So what that means is, they work for themselves, and you hire them on. And what will happen usually is you have to issue them what they call a 1099, right? So 1099, basically a report telling the IRS, hey, I hired this person, but I did not withdraw any taxes for them, right? So because when you hire an employee, that's what you have to do for them. You have to take payroll tax, you have to take Medicare, Social Security, you have to take that on their behalf and take a portion of it, right? You withheld it, and then you submit it to the government. But with independent contractor, as long as they make more than 600 more a month from you, you have to issue them what they call 1099. But that's only for U.S. Contractors. Why? Because on the 1099 form, they ask for a social security number. If you go hire a VA from Philippines or I don't know India, they don't have a social security number. So there's no way for them to fill that kind of form. So really, in that way, you really can't recognize them as an independent contractor. So there's a specific line on the Schedule C where you can put them on as basically a contract work, as someone who you're not going to be issuing a 1099 to, and you basically just lump them into a category and say, well, there's still an expense. I did hire someone, but it's not someone in the US, so there's no need to withhold taxes for them. And basically that's what you would do. And it actually works out better, honestly. And I can see why more and more people are hiring international, right? It's by one, is cheaper wages, and two, you can kind of escape this tax situation until IRS issues some kind of more definite guidance on it. I would say you should definitely take advantage of that.
Okay, so actually, if you have like 100 VAs, it's fine. That's no issue.
Yeah, yeah,
Okay.
it really is. Yeah, it's crazy, I know, and I'm sure one day the Congress is going to be like, hey, this is unfair. This company can hire 100 VAs, but for now, yeah, this is the way to do it.
Okay, understood. Okay, Trent asks, you mentioned bookkeeper and accountant is different. What's the difference?
Okay, yeah, Trent. Yeah, I'd love to answer that for you. So, I mean, it's in a way, it's almost like just terms, right? But if you really want to define it, a bookkeeper is just someone that's who's solely responsible for making sure you have good records, make sure your transactions are in order. So, you'll supply that person with your bank statements, your credit card, Shopify report, your merchant fee report, and all kind of things like that. All your expenses that you got on a daily basis, and he is basically responsible for making sure that it's put in a coherent manner. While a tax accountant's job is to take what the bookkeeper has done and prepare tax filings for you. So in this way, if you hire a bad bookkeeper and you have messy books, it can affect how the tax accountant does his job, right? Because all tax accountant can do is take what you give him as far as a monthly report of your books, and just take that and say, okay, I think you're able to take these deductions. So if the bookkeeper doesn't do a good job of categorizing, setting up your chart accounts, you can actually miss out on deductions that way. On the other side, of course, is you have amazing bookkeeping, but you have a tax accountant who's not very knowledgeable about what's going on, what's the current tax laws, what the changes are. Then they can just be like, okay, I'll just fill out what I know, and then put it on a sheet of paper, right? So you can actually mess up both sides, and that's why we really recommend you hire just one firm or one agency that can take care of both sides for you. It just creates more synergy, and you kind of ensure that you won't miss out on all the tax deductions that you really deserve.
Okay. Okay, last 3 questions. Okay. So
yeah, sure.
Amanda asks, what types of services do you offer? How can you help us, basically?
Yeah. So, I mean, that's something that we really emphasize here at FCF Agency, is that we're kind of not your typical tax preparer firm that you can Google, or you can just, I don't know, even worse. I heard one of our clients found someone on Fiverr, but paid him like very little money, and then it was a disaster. Okay, I tell you that story sometime, Jonathan. But so we like to think of ourselves as kind of like your outsourced CFO, right? Kind of an extension of your brand that's not just gonna help you during tax season time, but really gonna help you all year round. Like we want to be your reliable, trusted advisor, That's going to be anytime you need to text us or chat to us about, hey, I have something going on with my company. I'm not sure if I can do this. Can I set up my company in a different way? Can I invest in these things? What do you recommend? Should I buy inventory now versus later? Hey, I'm working from home now. These are all the deductions. Like, we want to help you any kind of questions you may have. And not just tax related. It can be bookkeeping related. It can be your financial forecast. It could be valuation. It could be when you want to sell your company. That's kind of like the background that I have, is that we kind of want to help you in all aspects of the business. And we hope that that's something that if you guys are out there looking for, someone that's just not there just to help you with your taxes, you can come and, come talk to us, and we would love to see if we can help you out.
You mentioned before the call, your partner has experience in M&A as well, right? Is it so?
Yeah. My partner Stanford, he's more on the valuation side, so he has done more on the financial forecast side of things. So he's very good at knowing about like valuation and how much your company's worth for your brand.
Okay, yeah. So guys, if you need help with that M&A, can go to them. Second last question. Amanda said as well, biggest mistakes your client has experienced. Most common, I guess.
The biggest mistake is. Yeah, the most common mistake is basically like Googling and hiring the cheapest person. Like, I know a lot of people don't think this is a big deal, right? They're like, hey, oh my God, it's February, time to file my taxes. So let me just go hire the cheapest person. Let me just, use TurboTax or something, right? So the problem with that is doing yourself works when it's just your personal tax, right? Personal tax, there is just not as much deduction and credits you can think about. There's still some you can take for sure. You can still itemize versus taking a standard deduction, things like that. But on the business side, with the volume you're doing, with the sales, with the amount of sales that you could possibly be doing, there's just a lot more things you can miss. And missing it it hurts. It hurts. We have clients come to us that have missed, tens of thousands of deductions in prior years. And they're like, I can't believe this, like they didn't check this, they didn't do this. And I'm just like, well, you went and Google, or, you asked your family friend for who they did their personal taxes, and you hired that guy. That guy's not going to know what you are. They're just going to treat you as a personal tax preparer, like person who just needs like someone to fill out some forms for them.
Yeah.
Really.
Stuff.
Yeah. Like honestly, just be frank with you, Jonathan, filling out a form is not the hard part. I can teach you right now to fill out some forms, right?
Yeah,
I can teach you how to fill out this form.
You can watch it on YouTube.
Yeah, you can YouTube it. Like, you seriously, like, you can go right now and search on YouTube for someone that's like, hey, how do I fill out my tax form? And you can totally do it. But the problem is, if you don't understand your financial records, if you don't understand your bookkeeping, it doesn't help you. You could be putting down numbers that are not verifiable, meaning you don't have good backups for it. So you're just putting down a number now. That just put you at risk, first of all.
Yep.
That just sets you up for, not for you to have sleepless nights thinking about, oh shoot, did I put this number down right? What I just put this number down. I hope they don't come after me. And you don't want that. Like, why would someone who's earning 7 figures more want to not sleep well at night? No, you want to be dreaming about. You want to dream about like what boat I can buy, what Tesla I can be driving right now. Not, oh shoot, is the IRS gonna come after me? It's gonna be like a Wolf of Wall Street thing, It's the FBI wiretapping me, Like, you don't want to think any of that. You want to be rest easy, knowing someone who's competent is taking care of your tax and accounting situations, knowing you're well taken care of for now and for the future.
Yep. Okay. Last question from Daniel again. I think this is a good question. It's two parts, by the way. So the first part is, so Daniel has not charged sales tax in the past. So does he owe the IRS now? Then part 2 is, so in the coming future, he's going to charge sales tax, right? So how does he pay that? Yeah. Does that make sense?
Yeah, that's a great question. So Daniel, like, first of all, I need to first understand, of course, your situation, right? Like how much revenue you're bringing in this year versus all of your other expenses. But then one thing I would just say is, for whatever state you're in, I would, if you're doing a certain volume, I'm not sure, but let's say you're doing 300 to 500K annual revenue, I would start seeing what your concentration of customer is in that state, right? So I would say if I'm in California and I have 30% of my customers that's in California, right? Then you probably can do some rough estimate, something our firm will help you with, obviously, but if you want to do it yourself, a rough estimate of, you take the state sales tax, I think it's like 9.5. And then you multiply it by the amount of revenue you have taken for those customers, and you kind of get a rough estimate of how much you probably owed the state. So if you want to be in compliant, if your business is growing and you're not, scaling down or anything, you probably want to set aside that amount of money in an account somewhere. So then if you do get in trouble or anything like that, you do know that this is the amount you need to set aside, reserve for it, so you can pay for that taxes. And as far as your second part of the question is, okay, now you want to be compliant, which is great. The government love people who self-report. They love people who just like show up like, hey, I volunteered to pay my taxes. Please don't come after me. They love that. They're very forgiving for people like that. So if you go and now say, hey, California, I want to start filing my taxes, that's fine. Just just sites and forms you just got to fill out and just become compliant. Get basically a permit to sell is what they call it in the state you're in. And you'll be set up and on your way. And those are all things our agents can help you with. We can also help you turn on those features in Shopify if you don't know how. But basically, you just want to be let Shopify, I think, has a good feature. I think other e-commerce sites have this too, where you can just set up state by state of which state you want to start collecting based on what state they're buying it from, right? So it'll recognize that person is buying it from a California shipping address, so you need to start starting sales tax for him. But if he's buying from a Texas shipping address, then you wouldn't collect sales tax for him until you get to a certain threshold of customers in that state. Hope that answers your question.
Okay, Daniel, I hope it's okay. Yeah. Okay.
Yeah. Let me know if it doesn't.
Yeah.
You can always contact me later.
Okay, Ken. Alan, I really thank you for your time. Giving the audience like tons of value and stuff. Okay, now feel free to plug your stuff. How do people find you? How do they engage with the services?
Thanks.
Like, there's so many things to think about. So yeah.
Yeah, appreciate it. So I just want to mention, like, we love helping online e-commerce owners. Like that's kind of like our passion and kind of like what I got myself into, especially when I was doing e-com last year and saw all the headaches that tax and accounting and compliance that was having a toll on these 6-7 e-commerce owners that should be enjoying the success that they have from figuring this stuff out themselves, right?
You guys do SaaS as well, right? Like software companies?
Yeah, we also do that. And basically any online business that you collect money over the internet, we help you with, because that's our main focus. So if you are one of those companies out there that haven't really have a good grasp on your tax and accounting and bookkeeping, I highly recommend you guys just set up a free consultation call with us. I'm not sure if it's still on the screen, Jonathan, but basically I have my contact information on there. It's Alan@freecashflow.io. You want to just email me. And then I also have a Facebook page and Instagram. Feel free to use any channel you guys want.
Okay, let's simplify. Where do we find you? Where's the number one place?
Yeah, you can just email me. I think that'll be probably the easiest. And then, but I mean, you guys feel more ready to set up a call. We also have our site where you can just click on it and set up an appointment with us directly, and then we'll just jump on a free consultation call with you. We'll understand your situation, and we'll see if we're a good fit together, and we'll go from there. Easy as that.
Okay, Ken. Thank you so much, Alan, for your time. Yeah, guys, we've come to the so Alan, stop. You can stop sharing your screen again. Yeah, we've come to the end. Thank you guys for watching to the end if you're still here. Yep, and thanks, Alan. You guys can find them at freecashflow.io/opt-in. Yeah, so I'll put the links and stuff in the description as well, and I'll put this video is really long, so I'm gonna put the time frames so you guys can press the questions by questions as well. Yep. Okay, so that's pretty much it. Okay, thanks, Alan, for your time, and I'll stop the recording now. Okay,
thank you so much, Jonathan.
Yep, see you guys.
Have a good day, everyone.